Hey everybody, welcome to this webinar. This is Shane Smoleny from Wolftrader Futures, and we are going to be started shortly here. I just want to make sure that we've got good sound and video before we get started here. We're going to be talking today about deflation and if it's possibly on the horizon, because I think it possibly is. This is the first time that I've seen this in a long time, and we're going to lay out a case here for that as we go through this presentation. So just make sure that we can hear everything. If you guys can hear me okay, just let me know in the chat. If everything looks good, we'll get started. If you're new to this channel, go ahead and like and subscribe to the video. Like the video, subscribe to the channel, and that would definitely help us out. We're trying to grow this. We have presentations for you every Saturday at 1 o'clock, different topics every week. This week is a new one. We haven't talked about deflation at all. About a year ago, last July, I posted a webinar on inflation before many of the news outlets actually posted that. I actually had that up because I could see that coming with the Fed. But now I actually see something a little bit different. I see the possibility of deflation coming to these markets. So let's get started here. If everybody can hear me okay, let's go. Also, I'd like to give special thanks to our two moderators. Our two moderators here are Pat Stone and Ron Peterson. Thank you so much for helping us out today with this. If you guys need to get in contact with me, I'm going to give you this information now. My email is shane@wolftraderfutures.com. Website is www.wolftraderfutures.com or www.fedjuice.com. The YouTube channel that you're on right now is Wolftrader Futures, so go ahead and subscribe to that if you're not subscribed to get these updates and notifications when we have these webinars or videos. And Twitter, the free Twitter is @Wolftrader FUT1. That's a good place to go. I put charts of the day. I also put notices when I go on different radio shows and talk shows and money, like the money show and circuits, things like that. That's all posted on the Twitter. We also have an email service you can go to on the website and sign up, and you can get email notifications too in terms of what's going on. So we have a variety of services here that we offer. We have our S&P newsletter here, which is the most popular newsletter. We have a lot of commentary on that. We have monthly commentary. We also have daily updates on that. We have a metals newsletter where we talk about copper, gold, silver, platinum. Daily Fed juice on that too. Energy, where we talk about natural gas, oil, heating oil, and gasoline. Cryptocurrencies, we cover a lot of currencies on this actually. We cover the US dollar, we cover the Australian dollar, the British pound, the euro, Japanese yen, and we also cover the euro dollar. Cryptocurrencies, we cover Bitcoin, Ethereum, Ripple, and Litecoin. The Uranian letter, this is not necessarily about trading, but this is about Uranian astrology, understanding it, what's going on. I did post a video last night about Jerome Powell, the chair of the Federal Reserve, and his chart, how that would relate to some markets. So that's kind of an interesting read if you can look at that. So check that out if you're interested in learning about just how astrology affects things in general. Stock ETF service, this is our new service. This is becoming very popular. We're starting this out at a introductory rate. It's going to go up in about a month, maybe about 6 weeks or so. So if you get a chance, you might want to check that out. We have 6 symbols. We're going to add a new symbol probably this week. I'm going to talk about that too. But it's really offered here at a discount rate to start out. So if you're interested in stocks and ETFs, this is something you might want to check out. The service is still expanding. That's why we're starting it. We're just starting this at this low rate, but definitely check that out. All of this together is the gold package. So if you want to purchase all of this at a discounted rate, you get a really good discount. If you get the gold membership, you get all these newsletters. So that's a really, really good deal if you want to get all the information. If you really want to go for it in terms of live updates throughout the day, this is the platinum membership. We have so many things to offer here. We have the Fed juices. We have trading services. We're now starting option spreads, which we did a couple. We did one last week and one this week on Tesla. We have the fast Fed break even, which is a swing trade system that now goes break even the next morning. So it's focused on minimizing losses. We have the Easy Timer 24 hours. We have the Pairs Trader, which we look at right now. We're looking at corn and wheat, and we're looking at the yen and the pound. I will be adding more of these pairs trades. And then all rates, by the way, are lifetime locked. So whatever you sign up at, that's your rate. So if these services increase in price, which they typically do as we add more features, whatever rate that you sign up at, that's going to be your locked rate. So as long as you stay signed up at that rate, that's your locked rate. If you're a platinum member, any new service that I add is going to be included in your membership. So that's a big deal because, for example, this the spreads trader here, that might become its own separate service, like option spreads, right? Well, that's already included if you're a platinum member. So really, whatever you get now, you lock that rate, and then you're locking future services. So it's a good deal if you really want to look at the whole picture. If you just want to look at one market, any of these newsletters are excellent. And then I think the stock ETF one is going to be, it's going to probably overtake the S&P eventually in terms of popularity. I think this is a really, really good base that we've started with here, and it's just going to continue to improve. Okay, so now that we've gone over those, let me talk about a quick disclaimer here. Trading commodity futures involves substantial risk of loss. There's risk of loss with everything. So any of you who know me know that I'm going to be talking to you more about the risk and the loss more than I am about the opportunity. I mean, in reality, you can lose money, you can make money. Okay, it's a balance, but I really want you to understand this because that's important. Past results are not necessarily indicative of future results, and we've seen this before. Even with trading systems that have been doing very well, sometimes they'll be doing well and then they'll stop working for a few months and then they'll start working again. So that's just the way that it goes sometimes. This is an educational service to go along with the book, A Trader's Guide to Financial Astrology. I wrote that with Larry Pesavento. And this is separate than my firm, Trading Ridge. This is a newsletter. So everything that you see here is educational based. The data used in the creation of this is public information. So everything is public information, even the Fed information that I get, it's all public information. The thing is, how do we use this to process this to give you a better picture of what's going on with the markets? One warning here about using fragments. We use a combination of Fed information and the cycles, so this stuff can change day to day. What the Fed is doing, we saw with that crazy news cycle week with the Afghanistan week, how quickly news events can change. So if you look at something this week, it might be different than what comes out Tuesday, right? Because this information changes. So you really need to get the daily updates to understand. I'm just letting you know. So that's fine if you want to tune in every Saturday, but just understand you're not getting the full picture. Terms of service, we never share your personal data. I don't sell your personal data. I don't buy personal data. Most terms of service, when you sign up, they're telling you they're going to use your email, they're going to sell your email. I don't do any of that stuff. You can subscribe at any time. You have to physically sign up for an email, so I'm never going to put you on a list that you didn't sign up for. My main terms of service is that you understand the risk that is involved. Also, all of these charts that I post, this is actually how it went down. This is what happened. This is timestamped on Twitter. So these are real charts that I'm giving to you guys in terms of what we gave to our subscribers. So a lot of times people ask me for, like, can I have back issues? Can I have an old issue? So what I do is I typically say, well, this is all timelined on Twitter. That's a better way to look at this. So those are time-stamped charts. All of this stuff is exactly what happened with the service. The good, the bad, the ugly. There's more good than bad and ugly, but there are some bad and ugly trades in there too, or signals. So of course nothing is perfect, but the charts that I'm showing you are real charts. Just full disclosure here. These are legitimate real charts that I posted to subscribers. All right, so webinar agenda today. So we have quite an interesting mix of events here to talk about. I think the theme here is going to be deflation. But we are going to talk about other things here. I have news and events, which we'll cover first. Then we'll cover the Fed internals. That's kind of like a market update in a way. I'm not going to do a full market update today, but I am going to talk about the internals and my philosophy on that, what I think is going to happen. Again, we did do a video last night on Jerome Powell's natal chart, which was really interesting. So if you are a member, a Uranian member, or you are a platinum member or gold member, check that out. That video is up. and it gives us some insights into some possible turning points coming up into the next few months. Double optimized lunar cycle. I'm going to talk about that, how well that's doing. It's doing extremely well with the S&P, as it is on most symbols. This has really become a very powerful forecasting tool. Then we're going to get into the fundamental concerns. This is where I talk about the deflation problem that I think we're going to be seeing here. Of course, the Fed will respond, and we have to understand that. So if we start to see declines, we're probably going to see waves of it down and up, down and up. But the point is, this is probably coming. Okay, so I'm going to show you some headlines and some fundamental concerns. Then I'm going to talk to you about the concept of the actual charts that are indicating that we are in some type of a deflation going on here. I have a new, not a new indicator, it's an indicator I've always used for my subscribers, but it is dealing with the what's called the price normalized MACD, and that basically tells us from a normalized standpoint what is going on with markets across a broad spectrum. So for example, we might want to be seeing what's going on with markets across a 10-year spectrum, a 5-year spectrum, a 3-year spectrum. That's going to tell us. It's really, really interesting. So we'll get into that. That's going to be a big part of what we do. Then the Fed juice and the double lunar together. I talked about this last week, but I'll show a couple more charts. We have a new symbol that we're going to add to the stock ETF. I'm looking into this. It's the VIXY. And that's going to be the short-term volatility index. It's an ETF. It's optimizing well with the Fed juice. It has a weekly options chain. So that's good because we're getting into these option spreads now, vertical spreads. I'm going to talk about the Tesla bear call spread that we did this week with the September 3rd expiration. This trade is over. It finished out of the money, so we collected the full premium. Market update, no, we're not going to have that. That's going to be here with the internals. And then I'll field any questions that you have going forward. So that's the agenda. Let's get started. All right, so news and events. So this should say 9/4 because today is the 4th of September. All right, new stock ETF service is up and running, and that is going well. It's popular. People are signing up. I'm having good feedback with it. We're adjusting. We're adding more things. We've added double lunar cycles to these now. We've added the 4 to 6 day cycle to these now. It looks good. There's many ways to look at a symbol in terms of how it's trending with this service. So we'll probably have 7 after we add the VIX to this. We're trading these vertical spreads now on the stocks and ETFs. So we're going to be doing this weekly. This is on the Platinum service. So this is a new type of a trade that we're going to do. It's going to be something similar to like a trade of the week. So like I'll announce, I've been talking about next week's setup already. But these are kind of like slow motion trades because we can see them setting up well in advance because we're looking at the Fed juice, we're looking at the lunar cycle, we're looking at the daily statistics, we're looking at the best RSI. So we're lining things up. So I have a play for probably Tuesday at the open for next week. Right now I'm looking at about 1 play a week. So that's what's going on. If you're just joining us in this video, I'm Shane Smoleny from Wolftrader Futures, and we're talking today about deflation coming up on the horizon. I'm just getting through the news and events right now. Go ahead and like and subscribe if you get the chance. And we're here every Saturday at 1 o'clock p.m. Eastern Time. Fed juice 3.0 is now in this 4.44 resolution. There were some corrections I've made on certain symbols, but overall it looks pretty good. Bitcoin looks amazing right now. The turns are getting picked up very well with this Fed juice. I do have this ready for the S&P, but I want to wait until this S&P comes out of this uptrend that it's in. It gets more into an equilibrium. And I'm working on the concentrated signals where both of these agree. With the S&P Easy Timer, which is now running 24 hours a day, I think going forward, eventually, this is going to be the way to go because we give it the full day to look at. We do have break-evens on that. So if it doesn't hit if it's still in the trade after a certain amount of time, it just gets out. So that's good to reduce risk. And then many of these systems were remodeled for break-even. Break-even is BE here. That just means that after a certain time, like these fast Fed trades, a lot of the times in like gold, it's 6 o'clock in the morning right now. It has to be ahead by 6 o'clock or the trade's over. And it's really been helping us here because like last Friday, before the jobs data, there was a short and it covered at 6 right before that big spike up. So this is helping us because right now this environment is difficult, especially with the S&P, because it's just going up every day. So if you have a short, you want to be out quick if it's not ahead. Same thing happened with the S&P. It got out on the break even on Friday. Easy timer, like I said, also has that break even. Now, streaming cryptos are coming. The reason this has taken a while is because I need to upgrade my system. I'm going to do it over the Labor Day weekend. So my goal is to have streaming crypto by Monday. And that's going to help us with the Fed juice, because right now I have the Fed juice on Bitcoin, but we're going to have Fed juice now on all kinds of crypto. I could do more than this. I have a full spectrum now available to me, but we'll be able to do Ethereum, Ripple, and Litecoin. The September newsletters are now available for a 7-day trial if you want to check those out. S&P metals, energy, currency, cryptocurrency, stock ETF, uranium, they're all available for a 7-day trial. Check it out if you're interested. And then the double lunar cycles are on fire across the board. These things are just really, really good. For the most part, there's like 1 or 2 symbols that are a little bit off, but most of them are doing very well. The US dollar is doing incredible. Gold has been doing very well. S&P has been doing well. I mean, you go down the euro, the pound, you go down the list, this has been doing incredible. So we have these in the newsletters, so they're there for you to check out. They're posted 1 month at a time. All right, so that's the news and events for this week. Labor Day Monday, obviously there's no trading Monday. There is a very positive transit Monday. There's like 3 trines coming up. So usually when that Jupiter-Venus trine comes, usually the markets love to go up into that. So, it's possible Tuesday will have a gap up or something in the market. It's possible with all that positive energy. It's just there's no trading Monday. So we're kind of missing that positive day for the markets. So I guess that would fall under news and events. But Monday has a very positive transit on it. All right, so Fed internals, let's talk about this. So the Fed internals are a way that I track what the Fed is doing, Fed operations. So going back to 2011 here, you can see that there are times, every time the Fed pulls back on these internals, the market does follow. However, there can be a lag here. So it used to be that the lag, if it was a long time, was a month or a month and a half. In 2011, when the Fed starts pulling back, the market did come back up and make a second high. It made a double top here. But then eventually it did melt down here into that 2011 summer crash. And I was on top of that months in advance. I called that in newsletters. I said there's a crash coming, etc. But the Fed was helping that out. 2012 here. This was the LTRO here. So eventually they start to pull back. This one took a month and a half for this to show up, but eventually it did show up. So it's not unprecedented to see lags in this when the Fed pulls back, but eventually these markets do come back. It's just a matter of time. Now, the situation now is definitely more complicated with what's going on with the central banks coordinating, but I still think ultimately this is going to affect the fate of the S&P. This is what it looks like right now with the S&P on a weekly time frame. The Fed internals are on a very, very sharp pullback right now. And I think eventually that will show up. I think it's just a matter of time. I would be very cautious about the S&P right into here right now. As long as the Fed is doing this, everything we've looked at going back to 2009 has told us this is a period of risk. But there can be times when this takes a while to show up. So looking at this here, you can see that when you go back to 2018, there was like a 6-month lag here before this shows up. This was the taper tantrum. This was part of the tapering that was going on. In 2020, there was a 3-month lag here, and the market did stall. So at the very least, you're going to see a market stall or a decline every time this happens. So we're only about 2 months into this. I know it seems like it's taking forever, but as long as this is occurring, I think the market's in danger here. And I think the very least we're going to get a stall, but it could be something much worse. And I think with the fundamentals coming in the way they are now, I think it could be much worse. So I'm just pointing this out. I know that there's a lot of bulls out there. You guys know that I'm usually a bull on this market. I've been a bull since I was a bull at the low of March of 2020. I don't think the time to be a bull is now. Here's a bigger picture here of the Fed. These internals are breaking down. They're still uh, indicating that the market is in danger here of some type of a substantial pullback. Okay, so when I look at this, I'm just laying the backdrop to what's going on with the deflation picture we're going to talk about. I do want to talk about the double optimized lunar cycle here because I think that this is a very, very important indicator to look at, because on the S&P has been ignoring a lot of these astro indicators. A lot of them showed us as a down in August, right? But this one was successful in actually picking up the moves on the S&P. So these green arrows are the actual double optimized lunar cycles. This is what was posted each month ahead of time in the newsletters. This is all posted information ahead of time. So none of this is back tested, backdated. This is actually how everything was laid out ahead of time. And you can see here that the market has done a very good job of following these arrows. So even though we've been in this uptrend, the market has been just really good at following this. All right, sorry, I'm having a pointer problem here. Here we go. Okay, so you can see here that it's been following these arrows pretty well. Going back to May here, you can see how well it's tracked the S&P. And even when we had these really weird jagged moves, this has been such a juggernaut. And I'm going to use that word juggernaut because this is the most accurate astro signal I've ever seen. And it's only going to get better because we are in a process of fine-tuning this. So this is a double optimized. So only thing I want you to focus on is the fact that this is a track record. This is the history of what it did. Okay, so don't worry about what it's called. Don't worry about if it came from the moon or the sun or whatever it is. It's optimized twice. It's using technology, mathematical technology that we use to forecast this into the future. And look at what it's doing. It's doing very well. So, and I could show you on other symbols too, like the US dollar has been performing very well. Gold has been performing very well on this, but this is really, just this alone, in my opinion, is worth the service. Just this. Just if you just knew these every month, you would have such an advantage over everybody. So that just went into a buy on Thursday on the S&P. So, all right, next thing is going to be the fundamental concerns. So I'm going to talk about that. So fundamental concerns, this is stuff that you would see like in headlines in the news. Normally I don't bring this up, but things are looking pretty dire right now. And when I see this in combination with the Fed, I think that things could get pretty bad. All right, so we have the letters here, A, B. What this is the Michigan Consumer Sentiment. And just to give you an idea here, this is going back to 2012 here, and this is current right here. So this was the sentiment level steadily rising here, kind of hitting a bunch of peaks into here 2018, 2019, 2020. This is right before COVID. That was kind of a peak reading, and then it dives during COVID. It climbs back, but it's diving again here, and it's at a level we haven't seen since 2012. So that's not good. And it's been consistently ticking down. Now, a lot of people will tell you this is Delta variant fears and things like that. Okay, well, maybe it is, but the reality is that's what it's saying. This is the private payrolls. We saw this, and I talked about this in the newsletter, in the S&P newsletter, that I thought that the jobs data on Friday would be terrible, and it was. And this is not a surprise because we saw the private payrolls come in short. They were about half of what they were supposed to be, and then the actual true job numbers were even worse. So another bad sign. There's uncertainty out there with the COVID vaccine. We're having a worse outbreak than we had last year at this time, but we have a vaccine now. So that's kind of like, that was unexpected. I don't think people expected this. This is the jobs report here. Jobs report disappoints. Only 235,000 positions added versus expectations of 720. So we're only coming in at about a third of what we expected. Again, that's not a surprise. I talked about this before. This was not a surprise to me. I was warning everybody about this, just as I'm trying to warn you about the market now, that all of this stuff is, to me, this is very obvious what's happening, especially with the pullback with the Fed. And eventually this will come to pass based upon what has happened in the last, since 2009 with the Fed. Here's another one. This one's interesting because it talks about the whole fair is foul, foul is fair concept of the distorted mentality that we're in now with the Fed, where bad news is good news and good news is bad news. And so the market was trying to figure out, is this good news? Is this bad news? Does this mean the Fed's not going to taper? The problem with the Fed, guys, is that I see is the inflation pressure. If they're getting pressure about inflation, that's what they're dealing with more than the jobs data. But this isn't saying, hey, look, people probably, they probably feel that the Fed is going to decrease on the taper. This is a weekly, I'm going to get out of the way here so you can see this. This is a weekly leading index growth rate. This is from ECRI, Economic Cycles Research Institute, by Lakshman Akuthan. He's excellent. If you get a chance to go over there and see his site, I recommend it. He does a very good job of forecasting recessions. Before 2009, before the Fed started, he could predict these recessions like within weeks. This is the world leading index growth rate. It peaked in March of 2021, and it's now currently back to where it was in October of 2020. So there is definitely a slowdown happening here. This is a global. So this is the weekly leading index. This is the global, and I think this is a global index, this one. I didn't see it on this chart, but typically it's global. But it's not good. You can see that we are seeing a slowdown. So we're seeing multiple indications here. We're not just seeing, we're seeing the jobs numbers come in, the private payrolls. We're seeing the payrolls come in, on the non-farm payrolls come in low. We're seeing the sentiment index low. We're seeing the weekly growth rate low. Now there are some other indicators like housing that is still strong, but you have to understand a lot of this now is being fueled by the Fed and the corporations that are becoming involved in the housing markets. And the Fed owns 1/3 of the housing market now. So I would use caution about the housing market as a proxy, just because the Fed owns 1/3 of those mortgage-backed securities. I think this is the problem here, guys. I think this is a problem. So we really have to parse out the data in terms of what's important, what's not. I think housing would be the last thing on this map here, because again, that's sensitive to interest rates too. And then the Fed's buying the mortgage-backed securities, and it's just kind of a cycle. All right, so here we're going to go. We're going to talk about negative divergences here. So this is the big thing here that I'm talking about in terms of the charts. So by the way, if you're just joining us on this webinar, I'm Shane Smoleny from Wolftrader Futures, and we're talking about deflation today. Is it coming for the global economy? And so if you're new to this channel, go ahead and like the video, subscribe to the channel, and that would really help us out. We're here every we're here every Saturday at 1 o'clock to give you guys a webinar on a new topic. So again, today is a different one than we've talked about in the past. In fact, I don't think I've ever done a deflation webinar before. This is completely new. So let's talk about how I'm measuring this on the charts. So I like to use all types of indicators. I believe they all have their place. So I use something called a price normalized MACD. This is an indicator that I've built, and what it does is it normalizes price across large swings. So when you have things like commodities that can double and triple in price, this indicator here will actually adjust for that price increase. So it's kind of like a log scale, but it's going to adjust much quicker. It's going to adjust on the chart. So it's important for MACD for equal comparison. So I want to compare what happened 10 years ago to what's happening now, even if the price has doubled or tripled. So we can find support and resistance, and we can find divergences. Okay, so support and resistance, I'm going to show you on the euro. We can see resistance levels, and then on these other charts, I'm going to show you divergences that we're forming. We have a lot of negative divergences right now forming on this. So no matter what chart you look at, it's negative. I can maybe find one positive chart right now. Maybe the Canadian dollar is positive, but pretty much across the board, every single asset class that I look at is in a negative divergence, or it's at some type of a support and resistance. All right, so let's get started here. So the first slide is going to be the euro. So let me explain to you what this is. This indicator down here, this is the normalized price adjusted MACD down here. So that's what this is down here. I'm going to circle this down here so you can see this. So these letters here correspond to the price levels up here. So you see A here, B here, B here, C here, C here, D here, D here. Now the cool thing about the normalized price adjusted MACD is you can tell the price of the euro here was 160 and it's getting down towards, almost down towards 110 here. There's a huge difference in price there, right? So what I want to do is I want to adjust for that price so I can compare what's going on here. So for example, when this MACD down here, this normalized MACD comes up to this level here, you can see that it comes back and it pushes back down at this letter A here. And you can see that corresponds to a top in the euro up here. Then it comes down. Let me see if I can get a better color here. See if that looks better. Comes down, it comes up, here's B. And on the chart here, you can see B, that's also a point of resistance. It comes down, it comes back up here, C. That's also a point of resistance. You see that? It comes down, it comes up to the point D. That's also a point of resistance here. It comes down, it comes back up to the letter E. That's also a point of resistance here. So this is a big scale. This is since 2007. But you can see every time it comes up here, it hits this level. This is a level of resistance. Okay, so every time it's hit that since 2007, it's come back down. So I have a very nice objective way to look at this. I mean, you could have drawn a trend line, but even the trend line won't pick this up. You see, if I do a trend line, it doesn't really pick it all up. It depends how you draw the trend line, but it doesn't pick it up the same way. Actually, just if I do the trend line, let me just show you here. So if you do a trend line, you know, depending on how you draw this, it's not going to pick up D and E down here. See that? It doesn't pick it up, but this does. So what does that mean about what's going on now? Well, the euro is coming, it's just turning lower. It's turning lower off of this level here. So letter E here, it's lower. It's not good. Now, I do want to show you that there are positive divergences that do come true on this. I'm going to show you on a few charts. They both work. So for example, if you could go back here on this letter A, so this letter AB here, you can see prices going lower here. And this is heading into COVID here. So this is COVID. So this is COVID lows right here. And you can see down here that this is diverging positively. You see how that's making a positive divergence there? So price was headed lower right here, but the normalized MACD was headed higher. So the reason this is important is because it shows us that at the COVID lows, there was positive divergences, right? That's good. That's what you want to see for a rising market. But that's gone now. Okay, that's over. Now we're back into, we've passed off of this resistance level. So I think whatever they've done right now, we're kind of at a peak in terms of what the central banks have done. And so it's showing up on a bunch of charts. Okay, so this is kind of the first introduction slide here, and I'm going to go through more here. This is the next one here is the US dollar. So the US dollar here, you can see that, first of all, heading into COVID, there was a positive divergence. So going back here, this is the dollar here. Each chart I do, by the way, is a different color. So if you're a subscriber, you already know this. If I do, the US dollar is dark green, the euro is light blue. So this is why when you go to different charts, you always know what chart it is by looking at the color. So I color code everything. Okay, so you can see here that back in 2009 to 2014, back here, we had a positive divergence here, that this was diverging up when the price was diverging lower here. And then in 2014, we get this big acceleration up in the dollar because we had that positive divergence. What we have now is a very different situation. We have a negative divergence here. Price of the dollar is rising, even though we had this little bit of a hook during COVID. You have a negative divergence forming. Okay, so ultimately these do resolve. At some point they resolve. Okay, next slide. I mean, guys, I'm going to go through. Look, I look at over 40 markets, over, and every single chart was bad on every single market. I can't find a good chart in terms of a long-term picture. So this is really why I felt like at this point I needed to come out and start talking about deflation, because last year in July, everybody was laughing when I was talking about inflation. They're like, oh, no, it's not going to happen. Yeah, it happened. And I made a video about it. I talked to you guys about it. This one I think is going to come to pass too. Now, this is gasoline. This one is not good either. You got these prices rising. So you got A here, B here. This is the rising price of gasoline. And you can see that we're diverging lower here from A to B here. So again, that's a negative divergence. These do resolve. And they usually resolve at least to the point to where the divergence starts. Okay? So just keep that in mind. Now, I do want to point out that before COVID, there was a positive divergence forming here in gasoline. So if you go here in gasoline from the letter CD here, you can see there was a positive divergence here forming before COVID. You had this lower gas price here during COVID, and then that resolved, right? It resolved. There's no longer a positive divergence on gasoline. So there are positive divergences that do form, guys. It's just right now every chart has a negative divergence on it. And I'm showing you these examples because I want you to see situations where it did resolve in a positive way. Here's another one, gold. Gold is in a big negative divergence, guys. You can see here that no matter how you look at this, you have this increase in price here on gold, and you have these divergences going lower, and it just turned lower off of this resistance level here. So gold had a resistance level right around here. It turned lower, so that's really not a good sign for gold on that long term. And again, guys, this is like, this is 15 years, so this is not something that may happen next week or the next month, but the point is it will resolve at some point. I do want to show you too that during COVID, there was a positive divergence down here. You can see down here, letter C, the little c here. This was diverging positive here, and gold was essentially running flat, and then we had this big rise up after COVID. So COVID produced a lot of positive divergences on markets, and they played out. So no matter what you look at, they played out. Next one I'm going to show you might shock you, but these are big ones too. Crypto, Bitcoin. Bitcoin's in a negative divergence here since May, so it's going down. So this is the letter A here. And since this low here, pushing up here, we are in a negative divergence on Bitcoin. So that's not looking good either. And guys, I looked for positive, I was looking for positive charts on this, but I just don't see any. Which tells me that we're probably getting at the peak of this liquidity cycle right now. Here's Ethereum. I know this is everybody's favorite play right now, but let me just show you so you can see for yourself, and you tell me. You tell me if this is positive. Okay? So the first thing we're going to look at here is, actually, this should say, sorry guys, let me just paste this in so you can see it. All right, so the first one here is going to be from A to B here. Ethereum is like a maroon color, guys, so those of you who are part of the service, you know that this is Ethereum. So here's A here, here's the peak of the normalized price adjusted MACD. This is diverging lower here, okay? Yet here we are persisting higher here. That's a negative divergence. And then on top of that, it makes this next run up here from B to C, and here's another negative divergence forming. So there's two negative divergences forming on Ethereum. Now there are situations where we had positive divergences on Ethereum. Down here right before COVID here. Price on Ethereum was kind of drifting lower here. You see this right here. It was kind of drifting sideways, but yet the normalized price adjusted MACD was drifting up. You see that positive divergence? That's a positive divergence. And then we got this big move up. So you can have these little divergences within the big divergences, but not a positive chart, guys. cocoa, similar situation, although they're both kind of drifting down together, but you have a double negative divergence here too. So you got one here. And I mean, I could have gone 30 charts deep into this, guys. I'm just showing you some of these highlighted ones here. You have a negative divergence forming here, and then from C to D, you have another one forming here. Live cattle's in a similar situation. This is not good. I'm going to show you two financials next. The first one's going to be the 10-year bond. 10-year bond's the pink color on our charts here, but you can see this letter A here. To B, we've been in this big uptrend since 2008. And we have a massive, massive negative divergence here forming on this. So no matter what asset class you load here, guys, it's all the same story, is negative divergences pointing to deflationary markets coming. Now, again, this is looking at years and years at a time. These things can go on for a long time, but the point is that, you know, this is showing up. Now, this chart's going to be a lot tougher because the Fed holds assets in these and all these different bonds. So the Fed typically makes better investments, and they tend to give positive returns on their investments. So I think this one might be harder to come down, but I just wanted to point it out that it's there. We can look at another asset class like the euro dollar here. Same thing, no matter how you look at this. So the letter A here, rally up to B, and then A here, falling down to B here. This is all negative, not good. So that was just a little sample of some of these charts. I am going to go into the S&P now and show you some examples. This is the dollar juice that we look at. So the dollar juice is an indicator that we do use. It's very good at forecasting S&P. This has been in a negative divergence or a sell for a long time, going all the way back to July here. You can see that this is a negative divergence forming down into here, and the S&P has been going higher on this. So there's a very large negative divergence forming here, and this indicator has been very good at forecasting the S&P, really good. If you go back through time, this has been just a very, very good way to get the broad-based trend of the S&P based upon what the dollar is doing. This is measuring the S&P relative to the dollar. So this is in a negative divergence too. And this is more short-term S&P. Now, this chart is really interesting because the S&P gets up to these key levels of RSI, even if it's in a bull market, and it does have these pullbacks. If you look back here, on the letter A back here, letter A back here is going back to April. So this is April here. This is May. This is June. This is July. This is August. And now we're going into September. So the key thing about this chart is that when you look at this chart, the most important thing is to identify these divergences. Well, first of all, there's two things. The first thing is the best RSI level. So for those of you who are subscribers, we take this best RSI level, and this is the level that the S&P likes to reverse at any given time. So right now it's 77. The S&P is relatively stable. Once it gets up to that level, it tends to want to pull back. So that's what this dashed line is. That's the best RSI level. It's optimized for this. But when it gets above into that red zone, it tends to want to reverse. So you can see the letter C here, it pulls back. The letter D here pulls back. The letter F here, it pulls back. So that's one thing to look at. The next thing to look at are divergences on this chart. So the divergences show up on this RSI. So this is just a simple RSI. It's nothing fancy, but it's really, really good to help you understand the S&P because the pullbacks have been very far and few between, very brief. But you do start to see these divergences form. When the S&P wants to have a little bit of a pullback, it usually comes after one of these divergences. So from A to B here, you can see there's the divergence. The letter C here just had a peak above the best RSI level here, and then it has a dip back here. From D to E, you can see that the RSI was diverging lower. Okay, so you see this, and then eventually it does come down. And currently we are in another one of these situations. So we're in a situation right now where the S&P is diverging lower, and from F to G here, this chart's a couple days old, but you can see here that from F to G, we have this negative divergence here, and S&P is going up. S&P did peak up above this best RSI level, so the S&P is at a vulnerable spot right now with this. So when we talk about negative divergences, guys, no matter what time scale we're looking at, no matter what symbol we're looking at, these do tend to resolve eventually. And so the S&P right now is still in a very, I think, a dangerous situation. So that's really the case I'm laying out here right now. So going back here first to what the Fed is doing, the Fed's pulling back here. Going back to the fundamental problem that we have here, the payroll problem that we have here, the delta problem we have here, the leading index of growth rate declining, all these divergences forming across multiple asset classes. This is a serious problem right now, I think, in terms of markets on a tipping point, okay? And then, of course, we're looking at the divergences here on the S&P and the divergences here on a local scale with this RSI. So everything's lined up right now, and at some point, guys, if we start dipping into recession, it's going to be hard for these markets to stay up. All right, so the Fed used double lunar cycle. For those of you who didn't get a chance, I'm just going to do a quick review of this from last week, and then we'll talk about our Tesla play that we did last week, how we set up that spread, and there's going to be more this week on that. So double lunar cycle, these are the actual signals that happened for copper. This is I just pulled another symbol up. They're all doing well. So you can see these are the actual buy sell signals that came up. It's incredible. And again, these were all given at the beginning of the month. So like this is all documented in terms of newsletters. You can see down here too, this is the actual rolling graph of the double lunar cycle here. And you can see that copper tends to follow the ebb and flow of this. So here's your copper here. Here's the letter A here. It kind of follows that same ebb and flow of these lunar cycles. So this is really, really just a huge advantage. Even if you just looked at this graph down here, you know, if you're trading copper or silver or gold and you just looked at this graph down here and nothing else, you have a huge leg up in terms of forecasting ability, because you're going to understand it just kind of gives you a roadmap of, oh, here's where it generally tends to do, here's what it should be doing at this time of the month, this time of the year. Big advantage. And again, these are the charts that were actually posted to subscribers. So this was an example of lining up the Fed juice with the double lunar cycles. So the Fed juice is this letter A here, this red letter here. The cycle low is the blue one here. And if they both line up within a couple of days, you tend to get a big run, which is what you got right here. They both line up again here. This is back into May. You got another run here. They both lined up again here. You got another run here. So I like putting these two together because when they both turn, I feel like you've got a better chance of a run. And this is going to lead us into this Tesla spread that we did, because I lined up all of the probabilities for the play this week, and pretty much went to plan this week. So here's another example of copper. Similar concept. It was coming down. It goes up into this high, up into this letter B here. They both went into the sell, and it came down. This is gold. This was a situation showing when there was a signal in isolation. The Fed used signal in isolation here, was not synchronized with the lunar cycle, and so this signal, this particular Fed use signal failed here. You can see this fails here. But when they line up together here, you can see when they're both lining up together, that then you did get a big run up into here. And then 823, it goes into a sell again. So the concept here is that I'm giving you a lot of information so you can put the pieces of the puzzle together for whatever you're doing. You can have, look, the Fed use says this, the lunar cycle says this, the daily statistics say this. They're all kind of lining up, and they're all different ways of looking at it. These are mutually exclusive events. The Fed use has nothing to do with the lunar cycle. The Fed use is dependent upon what the Federal Reserve is doing. The lunar cycle is based upon cycles of the past, and then also optimized with cycles in the future. This was Bitcoin here, so it works on Bitcoin too. I told you that the Fed juice is getting much better on Bitcoin. So you can see here that this Fed juice goes into this buy back here. This is July 29th, and then the cycle low comes a day later, and we get this nice move up in Bitcoin, and then 811 it pulls back to 819, and then to 823. You can see that you have the Fed juice sell here and the cycle high here, and we're currently still in a sell on the Fed juice on Bitcoin. So different symbols, same outcome. So that's the nice thing about this, that it's fungible. You can go across multiple asset classes, multiple futures, stocks, ETFs. It all works. This is putting two cycles together. So this is what we did with the spread this week, and I'll show you in a minute. But I like putting these together. So this is a big upgrade to the stock ETF service. So each week I'm analyzing new ways to add information to the services. So we have added the double lunar cycle and the short-term cycle to the stock ETF service. So if you're a member of the stock ETF service, you have these two new pieces of information to help you make a decision about the market, to help you understand what's going on. When these two cycles line up, you can see here the letter A here, that they both kind of come in and make a low into here, that the markets can tend to have bigger runs. You see right here, this is Tesla here, so this one hits a high here, this one hits a high here, and they both come down. So visually, this gives you a nice way to look at the chart. So instead of just looking at the chart and seeing, oh, there's an arrow on the chart, there's a buy, there's a sell, what does that even mean? Well, you can go back and visually look at it and see when these line up. So that's really powerful because it gives you your own way to visually inspect what's going on. Here's another one with Tesla. I've been using Tesla a lot just because it's a highly liquid stock. It has a good options chain on it. It has a weekly options chain. But you can see here they both come in with this low into here. Okay, and they're going to run up into this double high here. They both make a high here. And then the stock runs up. They come down here into C, where they both make a low. Stock runs up into D. They make multiple highs here. Here's a high here. Here's a high here. And this is the peak up into here. All right, guys, I'm looking for some reason. I don't see all the questions here. I'm going to read some questions here in a minute here. Okay, deflation, very interesting. I'm reading some questions here. What's the link to the guy that predicted many recessions? Yeller, businesscycle.com. Thanks, Pat. Uranium, default wires, flat, no divergence, mostly changed to basic settings. Okay, I'm reading something. It says, okay, the default Wilder RSI is flat, no divergences. Okay, let's talk about the divergences that I use here. Okay, so this is a question. So I use... Okay, so I use an RSI 5 chart here. So when you go to the chart here on this, let me show you here. This is an RSI 5 right here. I like the 5 because 5 is a week. So 5 is a weekly period. So you can choose any period you want, but I pick one and I stick with it so you guys can use this at home. So if you go to your computer and you type in RSI on the daily time frame 5, that's the one that I use. You could use any. You could use 3, you could use 7, you could use 10. I like 5 as a standard RSI. I feel that it picks up the divergences very well. So that's just what I use. It doesn't really matter what you use because it's a relative indicator. So for the best RSI here, it's 77% on the S&P. So when the RSI 5 of the S&P gets above 77 right now, it starts putting downside pressure on the S&P to reverse. So you can see here, like in this peak here, this is it here. My thoughts on uranium. Oh, I haven't looked at uranium, guys. I can add that in if you guys want to see it. No, I have not seen it. Uranium, that's a good one. I'll look into uranium. No, I don't follow it, but I can. Okay, so getting back here to Tesla. So we talked about these double peaks. So this is really important for you guys because you can see the double high here that came in on Tesla, right? So what does this look like when we put everything together? This is what it looks like. So you see this on the stock ETF service. This is what you see. So Tesla, went into this sell on 8:30, and I talked about this last week. I said, we had this peaks into here. Fed use was a sell. That was the time to do the spread, which I'll talk about in a few slides coming up here. This is really, really powerful because you have such a big picture now in terms of the statistics and everything to look at. All right, so where are we here? We are looking at, okay, looking at Tesla here. Okay, so let's keep going. So next slide here is going to talk about a new symbol that we're going to add. So I told you guys I'm going to look to add about 10 symbols to this service. So when we talk about stocks and ETFs, my goal is to have 10 symbols. So people ask me a lot about volatility. So what I'm going to do is I'm going to talk to you today about volatility. And sorry guys, I'm reading questions as I'm going here. I'm going to talk to you guys about short-term volatility and a symbol that we can use, which is the VIXY. This is an ETF. This is short-term volatility. And I like it because it's optimizing well in the Fed use, and it also has weekly options chains. So this is important. There's a reason why I'm choosing these highly liquid stocks and ETFs, because the whole time the plan was to move into using spreads on this. I want to teach you guys how to do spreads, or how to at least look at the information and come up with a reasonable plan to open a spread or whatever it is. Just combining this information. So this is all about educating and understanding how these cycles converge together. So this is an example of the VIXY, and if you're already a stock ETF member, this is going to be included. And these are just more of the symbols that we're adding. So this is the chart here of the VIXY, and this is dealing with an optimization sample period. So this was an out of sample period that I ran. So I ran an optimization, and it stopped about here, right? And this is out of sample, which means that this is, I ran this with the Fed use on my optimization software using a specific algorithm. And so it stopped here. So this is actually how it would have optimized on this volatility index. It follows it beautifully. It's got a very nice smooth pattern. And again, these have weekly option chains, which are great. So I'm sure these will have lunar cycles that will match it too. So I'll be looking to add these soon to it. And so you can see here that the Fed juice did go into, the Fed juice on the VIXY did go into this buy here on Thursday at the open. So that's increasing right now. So that's just something that we're looking into, but I think it's going to be a good addition. So just wanted to bring that up to you for news and events. So let's talk about the Tesla bear call spread play that we did the week of 9/3/21. So this is what it was. So we sold the 765 call, bought the 770 call. There was about a 35 point margin of error. So when we set the position, when we set this spread up, I aligned everything, and we had about 35 points. It had to move against us 35 points for this to lose money. The delta was 84% at the start. So when you look at these spreads, the delta is typically a rough estimation of the probability that you're going to close in the money. Actually, the delta was 0.16 on this. So there was an 84% chance that the trade would be successful. So when we started. So I aligned multiple indicators here. So I aligned the best RSI, the daily percent statistics. I aligned the Fed juice. I aligned the double lunar cycle, and I aligned the 4 to 6 day cycle. So all of these were pointed down at the time when I opened the spread. And so I opened the spread at the close Monday. So we had 4 days left. So we had 4 days for this play to not go 35 points against us, with all of the indicators that we use saying it was down. So I lined all of this up to the downside, and then opened this spread, and we collected the full premium. It didn't even try to go up. So that was the play. So we had an 84% chance. If it was random, if I didn't look at any of this, there was an 84% chance that it would be successful. Okay. And then lining up all of this, obviously that will help. All right. So here's the chart. So let me just show you how this happened here on the chart. I'm going to move out of the way here so you can see it. So this was the actual play here. So going back here, so this was, and actually I'm going to put in, I'm missing the daily statistics here on this. So give me 1 second. I'm going to put in the daily percent statistic of, all right, oh, perfect. Okay, so I got the daily percent statistic here. So just to show you, what did I do? Okay, so just to show you here. So first of all, I'll move this here. This represents the daily percent statistic for Tesla. So the first thing that I did was I wanted to make sure that we wanted to be short on a day that wasn't the best day of the week. I wanted to wait until the best day of the week passed. So on Tesla, the best day of the week, at least this is for next week, is Monday, right? So typically Monday, it tends to go up. So you see this right here? So you see this right here? So that's Monday. So what I did was I said, well, I want to wait until Monday at the close, and then that's when I want to put the spread on, because I know Monday is the strongest statistical day of the week. So that's the very first thing that we do. So guys, just the daily statistics gives you this huge advantage. If you just know this every week, you have a big advantage, because this is how these markets tend to behave. And the stocks and ETFs tend to follow this really well. So I waited until that day. Okay, so here's the Monday. All right, so let me clear this out. All right, so then if we go over here, okay, so we got letter A here. So this is the line, by the way. This is the spread line here on the chart. So you have the 770 by 765 here on this chart right here. So this is the spread line. So this is the point to where this spread has to be below this. Okay. So I timed this. So I said, okay, I want about a 35 point of error into there. You're talking about 30. It had to move against you 35 points. I waited until the strongest day of the week on Monday. So that's what we're looking at here. So this is the point of entry right here. This is our margin of error here. Again, if we did nothing, if we weren't looking at any of these indicators, it said there was an 84% chance that this was going to be successful. But I want to go an extra step. I want to go a step further. See, most of these option sellers, what they do, all that they do is they look for high implied volatilities. They look and look and look and look and look. Oh, look, this high, high. And they run these scanners. And they try to find mismatches or arbitrage or situations where they feel that the volatility is too high. I take a different situation. I want to line up all of the predictive power that we have and put all of that together and then put the spread open. Okay, so there it is. So that was where it was Monday at the close, and notice it just goes flat right here. Nothing happened. So we collected the full premium right here. Fed juice was in a sell. Notice the Fed juice stayed in a sell the whole time. See that? Double lunar cycle is going down the whole time. You see this? It did hook flat a little bit here, but essentially it was falling. The 4 to 6 day cycle was falling here. You see this? Okay. And then the best RSI pressure here, you see this red here. The best RSI pressure was putting that downside RSI pressure on this the whole time. So you see this like this. So what I did was I put all of the pieces of the puzzle together here. And then that's when we acted on this. We want to make sure that we're lining this up correctly for all of these different ways to look at the predictive power of the market. And all of these are a little bit different. The RSI pressure is totally different than the statistical power. The statistical power is totally different than the lunar cycle. The 4 to 6 day cycle is a cycle, but it's a little bit shorter, a lot shorter than the lunar cycle. The Fed use has nothing to do with the lunar cycle. So all of these events are different, mutually exclusive events that we're putting together to get an advantage on this. All right, so are there any questions about this? Let me know if you have any questions about the actual spreads here. Okay, so, all right, guys, so that's wrapping things up here. So just to review here again, if you do want to sign up, we have multiple ways to track these markets. We have the S&P newsletter, the metals newsletter, the energy newsletter, the currencies, cryptocurrencies, uranium, stock ETF, the gold membership, or the platinum. Remember, guys, if you lock these rates in, it's going to be locked in for life. And so with that, I'm going to open the floor up to questions. If you guys need to get in contact with me, you can reach me at shane@wolftraderfutures.com or www.fedjuice.com. We do have an email list you can sign up for here. So if you're interested, stop by, put your email in, and we'll send you updates and notices. Also, the Twitter is very good. The Wolftrader FUTU1, that's our free Twitter. If you want to get charts of the day, updates, when I'm going to be on radio shows, when we're going to have webinars, just different things, this is a good place to go. And so there's other multi-media and social media platforms you can reach us on, StockTwits and Facebook. But that's basically it, guys. So if anybody has any questions, go ahead and ask it right now in the chat. All right, guys. So we will be here every Saturday at 1 o'clock. So if you have any suggestions or questions that you'd like to see in another webinar, let me know. But the whole point of this is to help you guys out, give you guys an advantage, help you guys understand how to put together these cycles to get an advantage for what you're doing in these markets. There's many different markets to look at. So I would recommend that you try to look at more than one market to try to understand that there's a universe of markets out there. I know a lot of people like to look at just one market and focus on that one market, and that's fine. You might feel like you're good at trading one market, but just understand there's a lot of different markets out there. And if you can understand how these concepts apply to different markets, I think it's going to help you to be more balanced. All right, guys. So what am I see a question here. Very cool. Lots of information. You are welcome. Welcome. What am I bullish on? To be honest with you, not too much right now. There hasn't been a time where I've been more bearish across the board than I am now. I could see streaks, times, short windows where you could be bullish on things, but I don't really feel too bullish on anything right now. I went through these charts right now. We went through the euro, we went through the dollar, we went through gasoline, we went through gold, we went through Bitcoin, we went through Ethereum, we went through cocoa, we went through the bond, we went through the euro. I mean, no matter what you look at here, at least on the longer term, it's kind of a dangerous situation. So I am not bullish right now too much on anything. I will think about that question. I will see if I could find some little windows of opportunity. But I think the word here is just to be very cautious right now. I think things are overstretched. And when we get into these spread plays, guys, I am definitely going to be looking more towards the bear call side of the spread, the vertical spreads, because I feel that the S&P is more negative. If I felt like the Fed turned things up again, if I felt like the Fed could start to crank this back up, I might feel more positive again about it. But because of the economic slowdown in terms of what we're seeing, I don't like the equities at all or anything involved with it. And the strange thing enough is, for those of you who followed Elliott Wave for years, many of the Elliott Wave forecasters, they were always talking about deflation, deflation, deflation. Well, this is the first time that I might actually agree with them. I've never been a big deflation person, but when I see this across the board, I get concerned. So yeah, so cash is king. Yeah, definitely cash is king. Look, whenever you get a crisis, there are always phoenixes that rise up from the ashes, and you do get these strange sectors that show up and pop up as plays, like we saw with COVID, that we saw the COVID plays or things that involved people staying at home, like the Zoom conference calls and things like that. But we even saw Zoom is starting to fall off now too. So Of course, there will always be plays that can show up, and I can look for that for you guys. If you want, I can do a webinar on that to try to look for some bullish sectors. But um, I've never seen this many negative divergences in my life across so many markets right now that I see. So I think the word is caution. Um, I will say this though, and keep in mind this, that if this market does go off a cliff and does start to really fall, you have to understand, guys, the Fed is going to act, and they're not just going to roll over and go away. They're going to come in and they're going to try to push this thing back up. So this is why shorting the S&P is so dangerous, because you can have a market, you can have a market where the S&P is, let's say the S&P starts to fall like this, and then the Fed comes in and starts to stimulate. So you could get this weird situation where you get these wild swings in the market. It looks like it's going down, and they come in and they act. And so this is the problem with the S&P directly, because it's directly targeted. And so I always say, when you're taking on the S&P, you're taking on the dragon. So you're literally stepping in front of the dragon, and you are just trying to outsmart what the Fed is doing. And the Fed is very smart. They're very good at what they do. It's very hard for me to keep up with what they're doing, and I follow them all the time. Like the fact that they linked up with Europe, they have the international repo facility, the fact that the IMF stepped in with the $650 billion SDR allocation. They're acting fast. So this is why I like the concept of looking at other symbols too, like maybe some other stocks and other things, because you're not necessarily trying to come in and slay the dragon directly. You're kind of looking for these very small targeted plays, and you can be diverse and stay small with what you're doing. So that's what I would say about that. All right, I will try to come up with a bullish scenario for you guys, but right now I don't see it. I just don't see it. I'm a little bit concerned. I'll just leave it at that. I'm not going to try to come out with any doomsday. I've never been a doomsday person. You go on YouTube and you see all of these advertisements. Oh, the person who predicted the 2008 crash now sees the world ending in 2020. All of those type of ads. I don't do that. I just will say that this is not good, and we'll just leave it at that. So we've seen the central banks act before during COVID, but the question is, we're already doubled. We've so far extended now to where we were, that it would probably take some time for them to turn it back up if we do get a real big downturn here. All right, guys, so I am going to wrap this up if there's no more questions. Thank you so much for coming today. I appreciate you taking your time out here to spend your Saturdays with us at 1 o'clock. We will be here every Saturday at 1 o'clock. If you have any suggestions for webinars, please let me know, and I will be more than happy to put a webinar up for you guys of a certain topic or a theme. And of course, we are always here to work to make sure that you guys can get an advantage in the markets and understand what's going on. And so with that, I'm going to wish everybody a happy weekend, and stay safe out there, guys, and I will talk to you soon. Peace out.